Hello and welcome to Vox Markets. I am John Human and I'm delighted to be joined today by Richard Harpham, Chief Executive of XP Factory. How are you doing, Richard?
Yeah, really good, John. How are you?
Yeah, not too bad, thank you. Not too bad.
Good.
Yeah, some fantastic numbers this morning. EBITDA and revenues both pretty much doubling. I mean, there's so many highlights in there; it's hard to know where to start. But perhaps talk us through some of the sort of the key numbers.
Yeah, I suppose you've hit the key one. Is this sort of theme of doubling? So I think for the second year on the bounce, the team's delivered a business that's doubled in scale. So we've seen in round numbers, £45 million worth of sales being delivered to the 12 months to 31st December. And of course, whilst that in and of itself is a very good thing, it's really important that you see that come through the P&L as well. So seeing GP double, seeing EBITDA double, so £5.5 million of EBITDA being delivered post IFRS 16, I think is a really, really strong result. And I suppose, if we get into where that sales growth is coming from, really excitingly, it's from both businesses. So if anyone's new to the XP story, we have two brands. We've got Escape Hunt, a slightly older business, 6-7 years old now, market leader in escape the room activities. And we've got Boom Battle Bar, much younger, a couple of years old, competitive socializing, large format bars with activity around it, be it axe throwing, crazy golf, etc. And both of those businesses have delivered really strong performances in the year. We've seen Escape Hunt, deliver £13.5 million of sales in the owner-operated business, and that was 38% ahead of where it was last year. And most pertinently, it was 17% of that sales growth was driven by like-for-like performance. And that is something that I would really highlight. Escape Hunt, as I said, is a sort of 6-7-year-old business. Delivering that sort of like-for-like, where even the earliest cohort of 7 sites delivered 16%, playing the same games that they were built with all that time ago. I think that's really testament to just how well the team is kind of coming together and driving that sort of customer experience. So really strong performance in Escape Hunt. And then obviously in Boom as well. Yes, Boom is a much younger business. Yes, of course, you'd expect to see the maturing effect of all these new sites that we opened come good. But sure enough, we did. It was a 200% increase over where it had been previously. So it delivered £28.6 million of sales. And again, within that business, 29% like-for-like sales growth. So a really, really strong performance over the year. And as we said, it's important that those sales lines flow through the P&L. And so Escape Hunt has held steady at 42% EBITDA, really strong performance. That's all volume. We've not had any price running through that. And the full year for Boom owner operated was 18% EBITDA, within which 23% was the number delivered in H2. So really kind of putting us on that maturity map and profile that we'd expect. We've talked about this midterm target of getting to 20-25%, and I think you can see that we're very much on that journey. So exactly where we would hope to be. So strong performance.
Yeah, indeed, a very, very strong performance, and there were sort of multiple factors behind that, which I find quite fascinating. So you've alluded to organic growth without price increases,
Yeah.
and there's been a lot going on behind the scenes to really help you deliver that volume growth. What can you talk us through some of the things you've been doing there?
Yeah, I suppose it's multifaceted, as all these things always are. Firstly, the obsession has to remain on customer. So one of the metrics that I'm proudest of is actually not a financial metric at all. It's the levels of customer satisfaction that we deliver across both brands. And we have been consistently above the sector and consistently significantly above the sector, I would suggest, in that delivery. And this focus on customer is, for me, the thing that fundamentally underpins everything you do. If you can create good customer experiences and get your customers coming back, shock horror, like-for-likes kind of take a little bit of care of themselves. And because that then leverages really well through the P&L, we can focus on that volume growth rather than the price growth that is, in my mind, quite a short-termist solution to a problem. And so we were very careful to do that. We were very careful that when, supply costs were going crazy as we kind of came out of the COVID period, energy pricing was horrible. We were really careful to try and absorb as much of that as we could, because we kind of figured that A, it would normalize to a degree, and B, after that short-term effect where you've kind of covered these spiky cost bases, it's too easy to see that you've got your pricing out of whack with the market. And so I think, our positioning to be as affordable as possible, whilst hopefully delivering a really, really good customer experience to you, I think is, paying dividends. And so certainly, aside from that, we've put quite a lot of investment back into our existing estate over the year. We kind of manage our investment, be it into new sites or the existing estate or whatever it might be, based around the return on capital that we think we can generate. And we thought that we could generate the quickest return on capital by doing slightly fewer sites last year. So we only did 4 new sites across the business, but instead putting the capital back into the existing businesses, really to drive capacity. And so what you saw on Escape Hunt was in a number of locations, we were able to find space, create space to put in an additional games room to play. So where we could clearly show latent demand, again, rather than going for price in order to sort of fill that demand gap, we went for capacity to drive volume. So we did quite a few sort of expansionary things for Escape Hunt. That might have been taking out what previously would have been corporate rooms, meeting rooms. Actually, that's not returning as well as an additional game room would. Let's swap it out, put another game room in. Similarly, on the Boom side, I suppose it's a bit of a personal problem, but in a number of sites, we realized we were constrained on bar capacity. So how do we put additional bar space in? How do we rejig some layouts to kind of get better customer flow? How do we get more drinks into more hands more quickly? And what do we need to do in order to facilitate that? So lots of operational work looking to drive capacity. And we're not there yet. We're very much on that journey. There's still a lot more that can be better, a lot more that we can further do. But it's been really lovely to see the benefits of some of that work kind of come good in the numbers.
Yeah, indeed. And I think one of the interesting things for me was how much that's been driven by data, by harnessing insights from customer data, from operational data. Can you tell us sort of what you sort of gather and how you use it? Because that is, it's a state-of-the-art approach to running a business like this.
Yeah, we take this sort of stuff really, really seriously, actually. And for a business of our size, we've got a couple of really big hitting, very, very smart guys working in the team. One on the tech side, one on the data side, doing really nothing but that, so to speak. How do we force these insights? And so we look at everything through that lens. It's if I'm honest, it's a chunk of my background from way back in the day. So it's a way of thinking that we really like. But rather than taking sort of gut feel guesses, if you like, and there's a big time and place for gut feel, and don't get me wrong, it's a really important thing not to lose that. But if you can combine that with a data overlay, it's really, really exciting. So as an example, if we're considering how to better maximize customer flow, our start point will be to try and analyze what the sort of diminishing marginal return will be from every incremental incidence of every sort of game that we might have in Boom. So for example, we can show with a fairly high degree of confidence that actually by the time you're ready to put in your 3rd axe lane, actually you shouldn't, because having a 4th darts lane returns quicker. At the point when you're prepared to put in your 4th shuffleboard, actually you shouldn't, because it's better to put it into beer pong, and so on and so forth. So we're just constantly looking at data. We're constantly looking at kind of flow analysis, creating analytical proxies for the stuff that goes on in sites. And it's a really fundamental part of the way we run our business.
Yeah, makes a lot of sense. Very, very sort of modern way to run a business, and as you should, help us improve returns. Just in terms of the overall market, the opportunity is vast, and I think that's sort of reflected in what's been a very strong Christmas. I wouldn't say that's what's accounted for the whole year, but it must have been the icing on the cake.
Yeah,
it's been a very good,
amazing Christmas for us. And it's always when you're in a very young business, it's when you've got this massive kind of hockey stick forecast for the end of the year, but you're still sat in February, that feels okay. When you get into October, it's, oh my goodness, we've got to hope that we start to deliver this. But yeah, Christmas is obviously a really, really good thing for businesses like ours. But again, it doesn't happen entirely on its own. You've got to drive it. So we put the requisite investment into our corporate sales teams. That's a massive increase in corporate sales, and there is a lot of confidence to be gained, particularly on the Boom side, where the numbers are so big over that period. When you're walking into a week and you've already sold £500,000 worth of prepaid business, that's a really good feeling to have before your consumer business starts to flow. So you have to get your fundamentals right. And again, I'm not sat here suggesting that we're nailing it yet. There's still a lot more to do for customer flow. I think we can get more capacity out of the sites at those really, really peak times. So we're still working on how to do that. But yeah, Christmas is big for both businesses, as you would imagine, and to state the obvious, because such a lot of our cost base is either fixed or at worst, if you like, semi-variable. The leverage to cash is really, really high. So, in the month of December, Boom would have delivered 50% EBITDA, really, really good conversion. So it's a very important time of the year for us.
Yeah. And I guess it also reflects sort of something of a change in sort of the taste of what people want in terms of their leisure experience. It's gone from sort of, going out for a drink of food to something a bit more. Can you talk to us about the market and how sort of sticky that trend is, how secular it is?
Yeah, absolutely. If the question is sort of in and around resilience generally, I think that we're quite well set up for a couple of reasons. I think having the two brands is really important, and that gives you, for want of a better word, a bit of a natural hedge, if you like. Escape Hunt is much more family than Boom. And so the advantage there is that it means, in your half-term periods, your Easter holidays, your summer holidays, etc., Escape Hunt does really, really well with families. You get some really, really significant weeks at the point where typically bar businesses come off. And so that's giving us a little bit of a natural hedge there. In terms of the activities themselves, we've talked for a very long while about experience being the thing that consumers want, and certainly there seems to be no evidence that is in any way slowing down. And so where I think we're in a very good place with both businesses is that, unlike, for example, on the Boom side, a conventional bar business, we're quite busy in the early week and also during the day. So you will have a different customer set coming in and using your space during the day on a Tuesday afternoon, playing some games. Now that audience will then morph into a different type of crowd in the evening as it gets a little bit more boozy and you run into the night. But the fact that you've got that cover, and again, referencing that fairly fixed cost base, gives you good leverage that other businesses in our space don't necessarily have. So the fact that you've got this kind of multi-use customer, the fact that you're able to attract corporate business as much as consumer business, and the fact that we're in that experience space where fundamentally we're creating events, if you like, that allow people to have those celebratory moments, have those kind of real high five moments with their mates if they're coming into either brand. I think that's a really important thing. I think that is sticky, and I think the kind of the like for likes are kind of talking to that in a market which typically is quite a lot softer.
Yeah, indeed. So where does this take us from here, both in the short term, throughout the rest of 2024, which I understand has got to a very good start, and beyond? I mean, the market opportunity, I think you refer to it as sort of 50 plus escape hunts, 100 boom bars, and obviously, there's international opportunity as well.
Yeah, absolutely right. I mean, you've absolutely hit the numbers that we've talked about previously. The UK runway for both businesses, we really think, is quite significant. Obviously, our growth is sort of a result of the cash that we generate. So, because we're, generating capital organically, of course, now that then a lot of that will go back into site expansion. So, off the capital base that we generate, we can probably do somewhere between, depending on the mix, probably somewhere between 6 and 8 sites a year, which is a good rate of growth relative to where we are. But what, as I say, we focus on is less about the number of new sites we build and more about where we return capital quickest. So if we have opportunities to do a rehash in one of our existing sites and we think that will return more quickly, we will prioritize that ahead of building another site. So a really good example of this would be in the O2. We had a Boom site in the O2, and we noticed that we were missing a real trick with the crowds that are turning up to the events there. And because we were being known, if you like, as a bit of a games-led business, we were missing the drinking before the shows. So we put in a cocktail bar on the lower level of that floor, and in so doing, generated significantly higher sales each week. That will pay back in a very small number of months. It's a really good use of capital. So we will strike that balance between site growth, going after that which we know is the opportunity, and creating the returns within the business as already exists.
Yeah, indeed. And it feels like you've hit that point of scale, critical mass. We're there, and as you say, sort of self-funded growth from here on in.
Yeah, an operating profit of 1.8 million quid is, that's a real milestone moment as well for the business. It's the first, obviously operating profit, has a lot of stuff clearly that sits underneath EBITDA, depreciation and amortization being the key driver. And obviously, if you're growing a very significant number of sites relative to a small base, that depreciation amortization number is aggressive relative to the rate of pace at which you generate cash flow from the units. And so the fact that we've sort of gone through that transition now, we're starting to show, fairly decent levels of operating profit is a real milestone for us as well. And so you're right, that critical mass piece has kind of come good at the right time.
Yeah, indeed. No, it's been an absolutely fantastic set of results. So many highlights. As I say, Richard, it's been an absolute pleasure talking to you, and congratulations on a fantastic
Thank you so much,
numbers.
and lovely to chat.
Thank you.